video lectures. I'll be taking you today for the lecture on audit sampling. And audit sampling is guided by ISA 530. This is one of 4 videos, so please make sure that you watch all of them so that you've got a detailed understanding of audit sampling. We didn't cover audit sampling in level 1, and so this is a level 2 topic, and also for the full-time students, this is a topic that you need to master and you need to understand. Alright, so as usual we go through the whole auditing process just to remind you which part we're at now. So we did engagement activities and we did planning. Now after planning, we're at the stage of obtaining audit evidence. And in the process of obtaining audit evidence, you cannot go and test the full population or everything that the client did during the year. But you actually then have to extract samples so that you can use those samples in testing, whether it's testing controls or doing your substantive procedures to obtain your evidence. You need to obtain your evidence from a sample. So this is the stage where we are at now in the auditing process. All right. So we've got objectives for the first session, which is this one. So our first objective for this session is to give an overview and an introduction to audit sampling. We also want to define audit sampling related terms. And we'll also be discussing the types of audit sampling methods. Okay, so let's just get an overview of what it is. So you find that technology will never eliminate the need for auditors' degree or the need for auditors' reliance on sampling. Because at some degree or at some level, they need to rely on human intervention. So, for example, testing of controls, that will require human involvement. So a computer cannot just do everything. And in terms of the auditing process or the audit evidence gathering stage, that is why the need for sampling will always be there. You find that sometimes you will need to physically verify assets, and that's done by humans. You cannot go and physically verify each and every asset of an entity, but there will be need for sampling based on, we'll see what we can sometimes base our samples on. And in some cases as well, in many cases as well, the auditor will need to obtain evidence from third parties, be it the bankers, be it lawyers, be it debtors, be it creditors. You find that because of that, there's always need for the auditor to pick certain samples, to pick from the population what it is that they're going to be testing on or performing procedures to obtain evidence on. So that is the need for sampling. Let's get into the introduction now. And our introduction is telling us that there's need for sampling, and in that need for sampling, the auditing standards, as we said, as governed by ISA 530, permit 2 types of sampling. That is the non-statistical sampling as well as the statistical sampling method. However, you'll find that technology advances have reduced the level of reliance on sampling. Firstly, because of automated accounting systems, the design of new automated accounting systems and that are well controlled, that has reduced the need for sampling, because if it's a well automated system, you might actually you can be able probably to test on a lot or on everything. And then the introduction of powerful PC audit software, which then can be used to download and examine client data. That reduced also the level of the need for sampling, because once you've done that, you can actually test the whole population. And this is because of the introduction of technology or the advancements of technology. So as I said, one of our objectives is to define key terms. And if you miss these definitions, you find that sampling will then be a bit difficult for you. So you need to understand, as we're going to go through these definitions, please make sure that you understand. So what is it that, or what are the terms that we're going to be defining? So we'll be defining what is audit sampling. That's number one. Next, we'll be looking at sampling risk. Because there is sampling, there will always be risk associated with that. So we'll define sampling risk. We'll also define confidence level, which is the level of confidence that we might want or to rely on or we might want to express. Then there's the tolerable and expected error rate. There's the population, sampling unit. Those will be the things that we're going to be defining, or the terms that we're going to be defining. So first, we're going to look at audit sampling. What is audit sampling? So audit sampling is the application of auditing procedures to less than 100% of the items within a population of audit relevance. So you've got your population of, let's say, debtors, and it contains 100% of the debtors for that period. That is the full population. And you're saying that if you're going to sample the debtors, you've got an audit relevance population, which is your debtors. You will be using less than 100%. That is what you'll be applying auditing procedures on. Okay. So you find that all sampling units in an audit sample, all sampling units should have a chance of selection in order to provide the auditor with a reasonable basis on which they're supposed to then want to draw their conclusion or their opinion on. So we're saying all these debtors, all of them should have not necessarily an equal chance, but should have a chance of selection based on sampling. Then we go on to audit risk, or sorry, sampling risk. So sampling risk, because you're not going to be testing on 100%, there's always going to be an element of uncertainty that enters into the auditor's conclusions anytime that they're going to use sampling. So we've got two types of sampling risk. First, we've got the risk of incorrect rejection. So the risk of incorrect rejection is saying that there's a risk that the sample that the auditor is going to use might actually be concluded as maybe let's say it's for an account balance. It might be concluded that the account balance is materially misstated. So therefore, we're saying that you've rejected that sample, but it might be rejected on an incorrect basis. Maybe you've rejected it incorrectly. So we're saying that the risk of incorrect rejection is saying that maybe the account balance is materially misstated when it is actually not materially misstated. That can as well go for test of controls, or it can go for your transactions, for your classes of transactions. Then we've got the second type. The second type, or the second risk, is the risk of incorrect acceptance. And the opposite is true for incorrect rejection when we now look at incorrect acceptance. So the incorrect acceptance is the risk that the conclusion that the auditor is going to reach by using this sample, they're probably going to accept that the sample or the account balance or the class of transaction is not materially misstated when it is actually materially misstated. But that is based on a sample. And that is to say that you might find that in selecting your sample, you might say that things are fine only because of the sample that you have used. But maybe the rest of the population that you left out, that you didn't actually test or apply auditing procedures on, might actually be materially misstated. So because you're going to be using or coming to your conclusion based on the sample, you will then reach a conclusion which is incorrect. That is your sampling risk. Then we go on to confidence level. Now we know that as we're auditing, there are degrees of confidence that you need to express. So the confidence level is the desired level of assurance that the auditor that the sample results need to support. And so you find that generally, let's say if it's for test of controls, if the auditor has decided to rely on controls, it means that the confidence level is probably set at a very high level. That is to say maybe 90% or 95%. And you're saying you are willing to accept that only 10%, there's a 10% chance that the controls are not working effectively, or a 5% chance. So in that case, when you've got a 90 to 95% confidence level, that means the level of assurance that you want to issue is very high. All right. So that's your confidence level. Then we've got our tolerable rate of deviation. Now the tolerable rate of deviation, that's the maximum deviation rate from a prescribed control that the auditor is willing to accept and still consider the controls to be effective. So what does this mean? This means that there's a rate. So remember we talked about our confidence level to say maybe it's 90%. So there's a maximum, maybe that would be 12%, a 12% chance or 12% deviation from the expected, that so that will be leaving you with a rate of, if that's 12%, that will be leaving you with a rate of 88% confidence level, or to say that the controls are working, 88% the controls are working. Or it can be even lower, to say that the tolerable deviation rate is maybe 3% or is maybe 4%. That is to say, that is your expectation that the controls might not be working. But even if that is the case, the auditor will still conclude that the controls are working fine. So that's the maximum level that the auditor is expecting when they're performing their test. They're saying maybe I'll find that a control here or control there is not working effectively. But even if I find one or two not working effectively, the auditor is still saying that the controls are still working effectively, generally or completely. Then we've got the tolerable misstatement. And so this is the application of performance materiality to a particular sampling procedure. Remember that we've got our performance materiality, and the performance materiality is set at a lower level than the planning materiality. So now you'll be using the performance materiality when you're actually going to test from your population. You're actually going to be testing, and you're saying, I'm going to be setting it at a lower level, let's say for debtors. It's lower than the planning materiality. So when the tolerable misstatement is saying, I'm going to set it at the performance materiality, or I'm going to set it at an even lower amount than the performance materiality. So that is your tolerable misstatement. And you're saying, I will tolerate misstatements for, let's say, the account, for the debtors. I will tolerate misstatements of this much. And that much, it can be a particular amount, because remember, performance materiality is set at an amount. So you're saying, when I'm dealing with my debtors, I'm only going to accept or tolerate misstatements as long as they are below this particular amount. And that amount is either the performance materiality or lower than the performance materiality. That is the level of misstatements that you're willing to tolerate on an account balance or class of transaction. Then we move on to population and sampling unit. What is a population? A population is the entire data from which the sample is going to be selected, and about which the auditor is going to draw a conclusion. So we can have, let's say, our revenue as a sampling, as a population. That could be our entire population. And so the sampling unit is the individual item constituting a population. So that could be just a particular sales invoice or particular sales receipt. That could be the sampling unit. Then we've got types of audit sampling that are used by the auditor. And remember, earlier we discussed that the standards permit both statistical and non-statistical sampling. So you find that in non-statistical sampling, the auditor does not use any statistical methods or techniques to determine the sample size or to select the sample items, and or even to measure the sampling risk. So no statistical methods are used in non-statistical sampling for those. And then on the other hand, which is what we will normally use and what is recommended to be used, is the statistical sampling. So statistical sampling uses the laws of probability to compute the sample size and to evaluate the sample results. So the auditor is able to most efficiently use the sample size and to quantify sampling risk. So when you use the statistical sampling, you can then define your sampling risk. To say, so maybe my sampling risk is at this level, because the method which you use to extract your sample will then actually is probably using the law of probability. Therefore, you can then quantify your sampling risk. So we've got, still looking at our types of audit sampling, we've got our advantages of using statistical sampling. So first and foremost, the design, you design an efficient sample if you're going to be using statistical sampling, because it's methodological. There's a methodology to it. You're using probability, the laws of probability. So your sample is going to be efficient. And then even the measure and sufficiency of the audit evidence obtained is of a higher level. It's better. As well as you'll be also able, as we discussed on the other slide, to quantify your sampling risk. But everything has its disadvantages. So you find that sometimes training auditors in the proper use of sampling might not be done effectively, or it might be a bit difficult to do that. So that's a disadvantage of using statistical sampling, because if people are not trained, they will think that they're using statistical sampling when they're not using it effectively. As well as the time that you need to design and conduct the sampling application might actually be longer than for non-statistical sampling. And sometimes there is lack of consistency within the engagement teams or across the audit engagement teams. Then it means that there is no consistency, and you cannot really rely on the sampling that has been done from audit to audit. So that also sometimes is seen as a disadvantage. So that is all from part one. We were defining the terms and just an introduction to audit sampling. Let's watch out for part two of the lecture. Let's make sure that we watch part two. Thank you.